Welcome back to a special episode of The Macro Guys. Today, we're going to do an interview style. She's going to ask me questions. My guest today is none other than Papyrus of Nani. I'll link her channel down in the description. She just launched her channel, doing some anime review style stuff, and is the perfect candidate to ask questions about personal finance, right? So as somebody who's been doing this for a while, trading, investing, doing business, right? It's hard for me to think of what new questions are, so it's always nice to get a new perspective. So we're going to go ahead and just jump right into it. I have not looked at these questions at all. So yeah, this will be an honest, just kind of what my thoughts are on how to best answer these questions. Of course, if you're looking for a day trading home, check the links down in the description. Subscribe to my channel, hug your parents, call your family, and let's get into it. All right, first question.
Okay. Not all of these are about me. These are just things that I thought up. Question 1. If I were close to retirement and have a strong savings in money, but haven't really invested up until now, and I want to invest but have access to it, are there better options than a CD?
So the question is, if you have savings, you're a little bit older, you're close to retirement, you have your money in a CD. Yeah, so I would say a CD is probably not a good vehicle in general. There are better options. Interest rates are pretty high right now, so there could be an argument for using a CD right now because they're tied to interest rates. Interest rates did go up, but you probably want to be in a more conservative still investment account. You could also invest in something like bonds, which give a fixed return. Okay, so if anybody's not familiar with bonds are how the government raises money for things. Okay, so when we want to build a school, typically, okay, there are corporate bonds, but you sell bonds to raise money. Okay, so I'll sell you a bond with a return of 8%. Okay, so you're going to get an 8% return on that bond, like fixed. It gives you a fixed return. So there's things like bonds which fit better into the portfolios of older people because, you know, when you're younger, you're looking 40, 50 years out. When you're older, you're not, right? So you want things that are more conservative. Bonds are more conservative. You're not going to get crazy growth, but you're going to get an expected amount of growth. I wouldn't use a CD though, because CDs typically have the worst returns, right? So you still want to get exposure to the market. So that'd be my first thought.
If I wanted to go get a bond today, what would I do?
I wouldn't necessarily say just go for bonds. So what you probably want to do, it's going to depend. So it's going to depend on how old you are, what your savings is, but at a minimum, you want a diversified portfolio. Okay, so in this context, so you want access to equities, which is going to be like the stock market. You want some bonds in there, right? Which you can also get on the market. So you can get a portfolio of bonds just like you would invest in Apple. You don't have to go somewhere special. There are bonds, there are bond ETF. So there's like bundles of bonds, things like that. But yeah, it's something you probably want to talk to with like an advisor. There's calculators to figure out the exact mix, but everybody's going to be different. Like the more you look into this, the more different your answer might be. If you just want like the safest answer, I would just say go to like a calculator that figures out like a target. Like Fidelity has these things like a target rate fund, and it'll tell you like what a good portfolio mix is for your age.
Okay.
Yeah. Assuming
I don't know what an advisor is, am I going to a bank? Am I going on M1 or Robinhood? Am I doing...
So I have a very mixed view on advisors in general. I think they're great for people who know nothing, okay, and are starting from zero. So, which is most people. Once you start to learn about the market, like you definitely can invest yourself. Like anybody can go and do what a financial advisor does. Okay, financial advisor's number one job is to keep you accountable. It's not anything else. It's not to invest for you. It's not to give you a better return. Like a financial advisor is basically saying, hey, you need to invest every month. Hey, you need to invest every month. Hey, you need to invest every month. And if you do that for 40 years, 50 years, you'll have a couple $1 million when you retire. So that's what financial advisors really do. Like there's no financial advisor that's going to be like, hey, invest in this. And like, they're not stock pickers. That's not what they do. So you could go to really anywhere, but just keep that in mind that a financial advisor, their primary job is to get you to do or to have good habits for retirement investing. A lot of caveats there. Retirement investing, you're investing, assuming you're retiring at like 65. They'll often have you pick a date. They'll have you fill out a questionnaire, but their job is to get you to do consistent good habits. That's their primary job.
What is anywhere?
This could be like Chase. You know, I used to work at Edward Jones. You know, Merrill Lynch has advisors. I don't have a recommendation. I'm not going to like endorse anyone.
But just if I have no idea, like
go to your bank, talk to a few, find someone you like. It is a personal relationship, right? So again, think of it almost like a coach, right? Their job is to keep you accountable. So you'll want somebody that you like and that you trust. I would say that, especially since they're going to be looking at your investments for a long time. So if you start from zero, that account grows to 500K, $1 million over the course of years and decades and stuff. Or if you're older, maybe you're putting a couple $100,000 that you already have with them. So you 100% should find somebody that you like. You shouldn't find somebody like it's contentious, or even if you just don't vibe with them, like just go around, right? They're going to get paid percent based off of your portfolio size. So this is where it leans into where I don't like financial advisors. Like, you can do this yourself, but if you don't want to do anything yourself, you just want to go to an FA, find somebody with very low fees and that you vibe with. Right. But yeah, talk to your bank. You could go to like an Edward Jones private office. Merrill Lynch has these things. There's tons of financial advisor services.
Okay. Can you get bonds with your regular investing for like your Roth IRA?
Yeah, you could put bonds into any portfolio.
And you would just look up bonds, or?
Yes, there are bond funds where you can invest in bonds, but yeah, you typically want to, and for a retirement account, you're gonna be investing in bonds like you would like any other stock. Yeah, but again, you don't want to just be in bonds. You want to be like in a mix.
Okay, awesome. Thank you. Okay, how do I keep from the cycle of making money and spending more money and making more money and still feeling broke?
I don't know. That's more of a philosophical question, but that just depends. That depends on what you want out of life. I know people that they're fine living in a 130K house out in, cheaper cost of living areas. They're not in the cars, not anything, and they're chilling, right? I don't know that many people like that, but it's going to be easier to not chase, like keeping up with the Joneses, as they call it, right? I like cars and things. I'm an entrepreneur. So like my personal barometer of, spending is entirely different than somebody else's, right? Because I might have months where I spend 40 grand investing in my business easily. And then the next month it might be zero. And then who knows? It just depends on what I'm investing my money in. But as far as making more money and not constantly feeling broke, part of that is the economy right now. Inflation is way up. So housing costs, which is the primary driver of inflation, which people talk about gas and stuff like that, but you have to live somewhere, and housing costs are up like 40%, if not more. I'm doing this off of memory. I don't have the numbers in front of me. They're very high. So you can't avoid that, right? The only way to avoid that would be to leave where you live. The obvious flip downside to that is people live where they know, where their family is, right? And so it's not easy to just leave where your roots are, where your family is, or whatever. Like, you're basically being forced out. That's why inflation is such a bad problem to have, right? Because people say just move. It's like, well, I don't want to live in the ghetto. I also, like, my entire family and generations are here. I went to school here, whatever the reason is, right? So assuming all of that isn't an issue, right? Let's assume you're somebody who makes more money. I could tell you from experience, like, having a nice car isn't gonna, like, the newness will wear off, right? So I bought a car, like, I love my car, my M2. So I'm very careful. Like, if I buy, like, I look at nice cars all the time, but I know people with Ferraris, Lambos here, and it's the same thing. It's like, once you get a car, like, once you have it, it's way different than how you feel when you want it. So a lot of things you want because you can't have them. Like, think of all the things that you could get right now that you don't care about because they're easy to get, and think about the things that you really want. A big part of you wanting them is because they're hard for you to have. So if you can just understand that that's all that's happening in your brain, then you can find contentment. So, but again, it's different for everybody. It's not like you shouldn't buy a bigger house. It's like, maybe you want a bigger house. Mm-hmm. Maybe you like nice things. I like architecture. I want a dope house. I'm working on it.
How do you start though? Like, if I'm straight out of college, I've had my first job, I guess, maybe, or I'm getting my first job.
Yeah.
Or I'm getting my first promotion. Like,
I think, yeah, from that perspective and from a personal finance perspective, you need to know what your income potential is. Mm-hmm. So I was a software engineer out of college, so I knew that my income was going to increase, and I also knew that I was a little bit entrepreneurial, so I was always doing some consultative business on the side, right? I always had like random money inflows. Also managed my money terribly, right? I would spend crap tons of money, things like that. So if you're a teacher, for example, your potential income is pretty straight line. You know exactly what your raises are going to be. Or maybe you're working at a company with very fixed, like, promotions and income schedule. Mm-hmm. So it should be very simple to know what is within your means. So you shouldn't go crazy. My advice, the best way to really feel like you've made more money is, as soon as you get a promotion, to change nothing for like 6 months. Like, try to do nothing. I try not to celebrate, or try to celebrate by watching the money go in your bank account, right? That's something that I did a few times, where it's like, where I have money, just saying, hey, I'm not going to spend this for 3 months. And you just watch it. You just enjoy having the money. Having money in your bank account, you're actually buying, what you're buying is options. You're buying financial freedom, right? So you're not it's not that you're not spending. You've already spent the money. You've just bought time, essentially, right? So as soon as you spend your money, you're eliminating the option of not having to do anything, essentially. So there's always trade-offs.
Okay.
How many more questions we got, by the way?
I have 14.
Holy moly. All right, we'll go through it.
Are there tiers of investment that I should be doing that are appropriate for me? Like allowing me to save, allowing me to access that money, allowing me to get better returns over time? Like, is there, I guess, like a pie of how I should be doing this?
There's an order of operations more so than a pie. I think people try to over optimize too much, right? So the simplest thing to do would be like having an emergency fund first. Having money, no matter where it is, gives you options. So people are like, oh, well, I don't want too much here versus there. And it's like, look, dude, worst case scenario, you sell this, turn it into cash, you still have it, okay? Like an example, somebody who has $10 million in the bank versus somebody who has $10 million in real estate. Neither of those people are hurting, right? Worst case scenario, the guy in real estate is less liquid because he has to sell the house, but he could also leverage it, right? You have options. So what I would say is first focus on doing the right activities is way more important than optimizing it. So investing $50 a month is more important than doing it perfectly. Okay. So first have an emergency fund, investing, doing your 401k, then doing a personal account, right? That's a typical order of operations. But again, like it doesn't matter if you have $1 million in a 401k, you're not gonna be like, oh crap, I didn't do it perfectly. And someone else is like, well, I did it perfectly, but they only have $3,000. That's like, who cares? It's like, it's better like having money is always gonna give you options.
Okay.
Yeah.
Awesome. Maybe it was too complicated for this, but
Nah, ask it.
I want to ask what percentage of my salary should be invested, but I know that varies. Like at what point should that percentage be invested or saved? And I know that varies with different cities, different cost of living, different salaries. Is there some kind of formula for this or like a rule of thumb?
There is. In general, like you don't want to spend more than, it used to be 30% of your income on housing. A lot of people spend like upwards of 50% of their income on housing. And it really depends on what city you're in. Like if you're in New York City, good luck. I would say do as much as like when you're younger, do as much as you can. Because when you're younger, it's a lot easier to not have a nice bed. It's a lot easier to just rough it, honestly. So you want to put that time to work when you're younger. So invest as much you could, like try doing 20%. Okay, just throwing a number out there. And again, you're buying options. So if you want to reduce that later, you're going to have all of that money accrued where you were maybe doing too much, right? So the cost of doing too much is that you have less fun, things like that, but you could always peel it back. It's harder to go from 5% to 20%. It's much harder because now you're going to have to make some lifestyle changes that are peeling things back, probably. Speaking very theoretically, versus like, oh, well, we want to have a little bit more fun and splurge. I want to eat out now. So I'm just going to peel back a little bit and you have money in the bank. So I'd say aim for 20% if you're younger. There is no right amount, but the more that you do every month, the better off you'll be.
Okay. How do I become more active in my investing without getting too emotionally attached to it so that I'm not making sort of short-term decisions on long-term investment, but being thoughtful about the way that I'm investing?
How to become more active without getting too emotional? You need to just do the math. So just do the long-term math. I have separate buckets of money. So I have my long-term investments and I have short-term stuff from like day trading, my business. And my personal philosophy is money that I make from business just goes into my long-term portfolio. I don't really optimize my long-term portfolio. I put it into the S&P, let it accrue. So that would be my thing, is just understand your psychology. Just have different buckets of money, right? So you have money for speculating, taking bets, investing in business, investing in yourself, whatever it is. And you have money for long-term. And the simple answer there is like, if I lose all my speculation money, it's like I still have long-term stuff.
So long-term up to 20% if you are young, and then what you are investing is on top of that?
No, so I would say if you're young, you should really push it. Go for like even more than 20%, 20, 30% every month or every paycheck, whatever it is, into some investment account. Getting more active, I would just say, just do the math. It sounds simple, but get a spreadsheet, go to like a compound interest calculator and do the math. And you need to figure out, there's some very obvious trade-offs from managing things. They say, well, what happens if I'm wrong on the short term versus just holding this, right? And also think about doing, having different buckets of money is a very simple. It's like a budget for your investments. It's like, these are things that I won't manage. These are things that I will manage. And that's fine. But as humans, like, we're emotional. Nothing is ever mechanical with people, especially with money. We're very emotional about money. So you just have to understand that, which is why I think it's good to have different buckets of things where you can very actively, like, maybe you want to try picking stocks and things like that, see how it goes. And then you can have your long-term stuff where it's like, that's just going to be my diversified portfolio that grows over 40 years. Right. Yeah.
Okay. I think that just made me think of, say I have like $100,000.
Yeah.
How much of that would I like, at what point am I okay to short-term invest and have that speculative money? That's more the...
At any time, I would just say, so however you got the $100,000 was you're contributing some amount monthly to it. So you could either take some of that 100K, like 10K, and start with that. But what I would do is, say I'm investing $1,000 a month and 100% of that is to long-term. Well, once I get to 100K, I might do $800 a month long-term and $200 a month I'm picking stocks. So I'm splitting up my $1,000. So it's not so much.
That's just self-set. There's not like a...
Yeah, you just have the buckets.
Definitely.
Right. But the most important thing is having that monthly cadence, or whatever the cadence is. It could be bi-weekly, where you're putting money into the market and you just have that option. Right. Most people don't even get to the point. Most people are so try to optimize, like, what should I do? It's like, just getting to the point where you have 100K in the bank in the first place is way more important to optimize that. But then I would just say split that up after you get there in that example.
I think a lot of my questions are about optimizing. Okay.
It's fine to optimize it, but it's like the most optimal thing you can do is regularly invest every month. That's the most optimal thing to do. Like, so it doesn't matter, like, because for example, let's say your $800, it's going to grow. $200 that you take, the first stock you pick doesn't go well. The second stock you pick doesn't go well. Third stock you pick doesn't go well. The fourth stock you pick doesn't go well. All right. Well, you still have 8 times 4, which is $3,200 that you added to your long-term portfolio, which grew at 10%, right? Which is another, $340 on top of that, right? Quick math. So you're still growing that long-term portfolio and you're learning the market, right? Because speculating takes time to learn, and it's totally fine to do. Maybe the 5th stock you pick, 10x's, right? You hit a home run, it goes crazy. But what you don't want to do is stop investing in that long-term portfolio, switch completely to short term, and you've lost $1,000, another 1,000, another 1,000, right? So you still want to grow that long-term pile.
So would you treat speculative money like a hobby money?
No.
If I wanted to like join Trade Edge.
For trading is very, very hard. I won't call it a hobby.
I just mean like in terms of money that you allow yourself to.
Yeah. I wouldn't call it hobby money because I think words matter. Semantics are important. So you spend money on a hobby, right? Trading is something that you learn, so you should invest and like learn it properly, but expect that there's a cost to that, right? So you're gonna have to pay tuition, but I would not consider it a hobby money because your expectation is going to be to lose that money, and your expectations are going to drive your outcomes.
That's fair. I'm thinking about where the comfort of stepping off the ledge to pay that tuition versus that I feel that I'm investing in long term.
Yeah, that's where doing the math and projections can help, right? And protecting yourself. So by having it split, by still having that long-term nugget building, you're not going to feel bad by taking time to learn and invest in like trading, for example, or starting a business or whatever. But yeah, if you're not doing anything else, you're going to feel a lot of pressure. It's going to be harder. And some people do that. Like a lot of entrepreneurs, quite frankly, go all in on themselves. There's an argument to be made there, but we're not talking about that on this podcast. This is personal finance. So from a personal finance perspective, I would say protect yourself, split the budget. I personally, like, I could lose all my money tomorrow. Like, I don't care. Like, I'm a very risky person because I know that I'm capable of generating money. Like, I can go all in on myself. I would not recommend that for most people, right? Have a diverse set of skills, I can even just like go work a job, right? Something like that. But that's not everybody. So if you're like a teacher, again, or somebody with like fixed income, or you don't have access to high income potential, then you really just need to get a spreadsheet, do some simple plotting. It doesn't have to be crazy, and just understand what your growth potential is.
If I'm a college student or about to go to college, what are some good ways? Because there's limited money, right? But I don't want to go so far in the hole that it's like a long-term problem. What are some good ways to make sure that I don't set myself up for financial failure as a whole after? And also, is there any opportunity for investing in myself or am I just hold off?
That's a tough one. I would say it's good to start putting a money away in college. If you're talking about like tuition cost, I would say, just be realistic. If you're going to go and like get a film major or something like that, I would just recommend not doing that unless you have people who will pay for that for you, honestly. So this is the unfortunate reality of college, is that you are legally an adult, but by all means you're a kid. And the system is designed to give you as much money as possible so that you are stuck in the flywheel for the rest of your life, right? So you're stuck paying college costs, then you get a 30-year mortgage, you're stuck paying mortgage until you work until you die. That's how the system is designed. You get on these very long-term, pay it for the rest of your life plans, 30-year mortgage in college, okay? So you just have to know that and accept that those are the parameters. And so you can either, I think that college is still the best way to like get around about education because it's structured learning. So there's that duality there. But in terms of like investing in personal finance, just realize that every dollar that you borrow at 18, if you're a young person watching this, go ask people who are in their 30s or 40s or 50 if they're still paying for college. So like the answer is yes for a lot of these people. And just understand that they're still working to pay for those 4 years that you're young right now. You need to ask yourself if you want to do that for the rest of your life. And that's just a reality for a lot of people. And so the sooner you can pay that off, or if you can just make a ton of money to where you don't care, it's better. So obviously borrowing less is advice. In terms of investing and stuff like that, it doesn't really matter. The best investment you can make would be paying down your debt. So everyone's situation is going to be different, but look at your situation and do the math.
Okay.
Tagline of the show, do the math.
Do the math. Okay. Subsidized versus unsubsidized loans. Do the math.
Yeah. It depends on what you need, what you're doing, but subsidized are better, obviously. But yeah, well, we'll do a follow-up show, guys. That's it for this one, guys. Thank you for tuning in to this episode of The Macro with yours truly, Forrest the Investor. Check out the links down below in the description of this video. If you're looking for a day trading home, we have one trade edge. We day trade live 9:30 to 11 a.m. every single day. We're not a call out server, but we will call out some trades, and our focus is teaching you how to become a better trader. If you have questions on personal finance, stuff like that, leave them down in the comment section of this video. If you're a hater, I should check out some of the other comments on my videos. I definitely will respond. I love the engagement. Nonetheless, my name is Forrest. I invest in stuff you should too. See you in the next video. Peace.